We've got Michelle Girard of NatWest, the head of U.S. over at NatWest. We should mention, Michelle, that there are, as we were discussing a moment ago, needs versus wants that the Fed is going to be weighing. What are you expecting for the reality of the discussion to lean towards in their September 17th and 18th meeting?
Well, I think very much as you've talked about, this report won't push anybody off their prior position. If those who are leaning toward just moving more slowly at 25 basis points, there's enough resilience in these numbers that I think keeps that in play. Although I think, the 50 basis point camp, which, as you said, the market in reaction to these numbers is thinking is slightly more likely now. I think that, does come into play with those downward revisions. I mean, yes, the employment change was better than what we saw in July and better than what we had looked, certainly than we were looking for. But with those downward revisions month after month, as well as those large annual revisions that have been reported, it's hard to take the numbers today at face value. So again, I don't think today answers that debate. But I guess the bigger question is, did it really come down to just this one report? To be honest, for the Fed, they're going to look at the overall trends and the broader landscape, and so they're going to have, I think, pretty much the same discussion at the upcoming meeting as they would have had with a different set of numbers. It doesn't come down to just one number for the Fed.
Yeah, and so let's game that out a little bit more. Next week, once we get Consumer Price Index, CPI, when that comes out Wednesday, you're also going to get a look at a better kind of more pulsed look at the state of employment with jobless claims as well, continuing to come out ahead of their next meeting. You're also going to have producer. I mean, you could pick your data point. How much do those data points actually carry more weight than what we're seeing in the jobs market play out, at least in the lagging indicator of the monthly jobs report for August?
Well, I think what we've seen is previously there was so much focus on inflation because the Fed's primary concern was whether or not inflation was going to credibly return towards the 2% target. And I think we've seen enough evidence there that the Fed is more confident of that trend being sustained, the downtrend in inflation toward target. And so the concern has now shifted more toward the economy, and the Fed is taking a more balanced approach. So they're looking at both the inflation numbers that we'll see next week and the employment numbers that we saw today, as well as, you said, some more up-to-date information. But again, I think importantly, stepping back, it's pretty clear in terms of the economy that things are slowing. And so I think for the Fed, the real discussion is, where do you think rates should ultimately, kind of be, or where do you think you're going to have to get to? Because I think that plays a big role in the size of the move that you're going to make. If you think that given where we are, we should be probably a lot closer to neutral in terms of the rate stance, somewhere closer to 3%, and you're at 5.5%. There's a lot of room. A 50 basis point cut in that context versus kind of dribbling it out at just 25 a time. There's certainly an argument that the faster you go, ultimately, obviously the quicker result you get to the economy, and ultimately, therefore, the less rate cuts that end up being necessary.
Michelle, it's interesting. I'm taking a look at the market action that we were seeing on the heels of this print, and you're seeing the Mag 7 moving to the upside. A lot of the big tech names are recovering a little bit. The Bloomberg Magnificent 7 index is up 1.5%, which is certainly a different story than what we saw earlier in this week. What does that tell you about the market's thesis about the Fed's path forward and the continuation, or I guess lack thereof, of the rotation narrative we've been seeing?
Well, I think what's happening is that, as I said, the market is edged up its odds for the Fed to move more aggressively, to move by 50 basis points, which is now kind of an even bet in the market as opposed to just 25. So you are going to, in the wake of today's report, there's a perception you're going to see more aggressive action potentially from the Fed. But at the same time, the numbers weren't disastrous. The numbers are more consistent with a soft landing. It isn't, I mean, the idea that you could still see the Fed take a larger move, but it's not prompted by numbers that were alarming that suggest that the economy is slowing a lot more dramatically than we thought. So that combination, I think, is probably pretty supportive for for the equity market and for other asset prices. In a way, it's a little bit of the best of both worlds with, again, the idea the Fed could come in and do more, but the economy itself still showing decent resilience and nothing here that suggests you couldn't achieve a soft landing as opposed to, as opposed to an outright recession.
What does it mean for the tech trade specifically, Michelle?
You know what? We don't do equities here. We're a bond shop, a bond and FX shop. So I can't speak about the specific trends within the equity market.
Got it.
All that considered, Michelle, when you kind of game out, and I like the way that you put it in broader context of if they need to get to this terminal rate of 3.5 even, then what is a 50 basis point cut? But I guess on the other side, what is the risk that they run of cutting too fast, too quickly?
Well, again, given the posture of where we're at in terms of rates, that risk seems relatively low. But the concern is if you move aggressively, the market will start to price in even more aggressive action, which you might not feel is necessary. And of course, the biggest fear is that it ends up sparking, renewed inflation, or at the very least, sort of pausing the progress that you're making on inflation. If the market and the economy end up doing better, or there's greater economic optimism, then perhaps there's, again, companies are more willing to retain, kind of current prices, don't feel the need to be, we don't see those disinflation trends continue because they're, the economic outlook is more positive. So the last thing the Fed wants to do is to move aggressively and then end up having to, at some point, reverse course because they've moved too quickly and too aggressively out of the shoe. So that's the balance that they're clearly trying to strike. But I think the greater risk here is just falling behind. They have waited a long time to get confident on the inflation front. We do have tangible evidence of the economy slowing down, and you're still a long ways away from the neutral stance. It feels like, to front load a bit of the adjustment that needs to be made is certainly rational. And that's, I think, why it's on the table.